In the crypto world, some wallets lie dormant for years, like digital treasure chests from another era. On October 24, 2025, one such chest opened. A Bitcoin wallet untouched since 2009 suddenly moved 150 BTC, worth $16 million. This wasn't just any account. It belonged to a Satoshi-era whale, one of Bitcoin's earliest miners. For 14 years, this fortune sat in silence, its owner unknown. The move set the crypto community abuzz. Was it Satoshi Nakamoto? Was the owner cashing out, or just upgrading security? Back in 2009, these coins were nearly worthless. Today they're a dynastic fortune. The awakening of such an ancient player is rare, a direct link to Bitcoin's origins. Social media exploded with theories. Why? Was this a sign of a market top? Or just prudent asset protection? Some speculated the whale was preparing to sell, which could signal bearish sentiment. Others thought it was a simple security upgrade, a neutral move. The truth, no one knows. But the story captured imaginations, reminding everyone of the fortunes forged in Bitcoin's infancy. This single transaction became a Rorschach test for the market, forcing everyone to ponder the motivations of crypto's earliest adopters. It's less about the $16 million and more about the story, a living ghost from Bitcoin's past. The event connected today's high-stakes market to its humble, ideological roots. In the end, it was a powerful narrative, a reminder that the pioneers of crypto may still be out there, holding keys to unimaginable wealth. In crypto, whales are the giants, entities holding enough coins to move markets. A Bitcoin whale typically controls at least 1,000 BTC. As of late 2025, over 1,670 such whales exist, the most since the 2021 bull run. Some are early adopters, others are institutions like MicroStrategy, or BlackRock's IBIT ETF, which alone holds around 800,000 BTC. Whales' actions can trigger price swings. A big sale can spark panic, while a large buy can ignite rallies. Their moves are closely watched, they're seen as the smart money. But this concentration raises questions. The top 113 wallets control over 15% of all Bitcoin. This centralization is a double-edged sword, providing stability but also risking outsized influence. The decisions of a few can impact millions, making every whale move a subject of intense scrutiny. In a system built for decentralization, the power of whales remains a paradox. Their presence shapes the market's tides, for better or worse. Despite the drama, the market barely blinked at the Satoshi-era whale's $16 million move. Bitcoin's price held steady, no crash, no panic, just business as usual. This calm shows how much the market has matured. Today's crypto ecosystem is deeper and more liquid, thanks in part to spot Bitcoin ETFs and institutional capital. Daily ETF flows now dwarf the impact of individual whale moves. Whales themselves have grown savvier, using OTC desks and private trades to avoid spooking the market. Most large holders avoid dumping coins on exchanges, preventing sudden price drops. Meanwhile, the amount of Bitcoin on exchanges is at a 6-year low, signaling strong holding sentiment. With less hot supply, the market is less vulnerable to shocks. The awakening of an ancient whale is now more a historical curiosity than a market-moving event. The market's resilience is a sign of its evolution. If whales can't crash the market anymore, why do we still track their every move? Their actions offer clues about market sentiment and future trends. Analysts use tools like Whale Alert to monitor large transactions, early warning signals for shifts in the market. A transfer to an exchange often signals potential selling pressure. Moving coins to cold storage is usually bullish. Transfers between private wallets, like the recent Satoshi-era move, are often neutral, just security upgrades. Patterns matter more than single moves. If many whales send coins to exchanges, it could signal a market top. Tracking whales is about reading the deeper currents, not just reacting to splashes. Their moves are one piece of the puzzle for traders and investors. In a market built on transparency, whale watching remains essential. Whales influence more than just prices, they help shape the rules of crypto networks. In proof-of-stake systems, voting power is tied to coin holdings, giving whales outsized influence on key decisions. This concentration of power challenges the ideal of decentralization. A few wealthy holders can sway protocol upgrades or fee changes, sometimes against the interests of smaller users. In trading, whales use sophisticated strategies, OTC desks, algorithmic trading, and iceberging to mask their moves. They often sell into bull runs and buy during market fear, profiting from their discipline and patience. Their counter-cyclical strategies provide liquidity and stability, but also keep smaller traders guessing. Whales' actions can quietly steer the market's direction, even if they're rarely seen. Their presence is both stabilizing and controversial. A crypto aristocracy in a decentralized world. Understanding their behavior is key for anyone navigating the crypto seas. So, are whales a threat or an asset? The answer is both. Their concentration of wealth poses risks, potential manipulation and governance control, but the market's muted response to the Satoshi-era whale shows new resilience. Institutional liquidity, like Bitcoin ETFs, cushions the impact of big trades. Whales can still make waves, but they're unlikely to sink the ship. For investors, whale activity is valuable intel, not a reason to panic. Watching their moves can reinforce conviction or signal when to take profits. The era of whale-induced panic is fading, replaced by a more robust market. The giants still command attention, but their power to dictate the market is waning. For everyone else, the crypto ocean is safer and more exciting than ever before.